Let's start with the 50-year mortgage, because a lot of people got pretty upset because they view the 50-year mortgage as an instrument to keep you in debt forever, and that you'll own nothing and love it, and debt is a slave. Debt makes you a slave, and why are we doing this? Let's break that down. Number one, is the 50-year mortgage a good call? Well, if it were me and I had the opportunity to choose either a 30-year fixed or a 50-year fixed at the same interest rate, I'm choosing the 50-year. I'm choosing it all day long. Why? Number one, because it gives you options. When we talk about real estate, one of the most powerful things to keep in mind is how do you give yourself as many options on the table as possible? Why would you not want an extra 20 years or a lower monthly payment as an option? Why I say option is because how our loans work, there's no prepayment fee for you paying off your loan early. So there's nothing from stopping you from paying it off in 30 years as opposed to 50. But if you want the flexibility, you have it there. I think that's a smart call. Number two, a lot of the pushback on the 50-year mortgage is that your interest that you're paying is so much more than a 30-year fixed. The answer there is yes, it is. And if it were me, how I would look at it is I would get the 50-year mortgage, but I would pay it off as a 30-year. But I would keep the option on the table in case anything changed, because I don't want to spend more interest to pay off that loan. But here's the reality. Most people do not pay off their loans. Most people put a loan on a home, that home appreciates, and then they sell their house, and then they go into a bigger house, and then they put more debt on it. There's not that many people whose goal is to just pay off their house. We're going to talk about that though, because I actually don't think that's the holy grail, is owning a home and not having a mortgage. We'll talk about that in a little bit. The idea of debt being a slave. Now, this one's interesting because in some regards, I absolutely believe that. But we have to separate out good debt and bad debt. When we're talking about bad debt and debt being an instrument that will enslave you, what that's referring to is consumer debt. This is credit card loans. This is, really car payment. This is anything that you are putting debt on that is not an appreciating asset. That will absolutely enslave you. I would recommend staying away from that at all costs. But the problem we have is we're just told debt is bad. And then when we look at assets, we carry over that idea that debt is bad. And then we don't think we're supposed to use it on assets. That is the name of the game. Every single wealthy person I know understands how to use debt correctly. And this is something we do in our company. Our company, we have, I believe, 23 properties that we're managing. And out of those properties, there's debt on, I think, every single one. And when our loans mature, we put more debt on them. Why do we do that? For a handful of factors. Number one, if you're putting debt on an appreciating asset, that allows your investment to grow at a faster pace because it's not all of your cash going into the total value. You're able to borrow money to increase your return. Best example I can give. Let's say you're going to buy $1 million asset. And that $1 million asset you bought in cash. So you just put $1 million into the asset. And the asset appreciates by 10%. How much did you just make on your investment? 10%. But what if you were going to finance 80% of that asset? You're going to put $200,000 down. You're going to finance $800,000. And that same asset appreciated by 10%. How much did your investment grow? You just increased your investment by 50%. So I would absolutely recommend debt as an instrument to increase your return, but you have to use it wisely. You can definitely over leverage, add too much risk, and wipe your investment out. So when I'm talking about debt, I'm always telling you to do it correctly, do it conservatively. Don't take on too much risk unless you're comfortable with that risk. Now, here's another reason why I think everybody really had a visceral reaction to the 50-year mortgage. I think it's because of the WEF. The WEF went viral. Klaus Schwab, who I don't even think is there anymore. I think they removed that psychopath. But he had a book, and in his book, he made a statement that said that their goal is for all of us normies to own nothing and love it. That's the quote that stuck. And really what he's saying is we need to usher in socialism. We need a utopia where no one has to pay for everything and life is good, and get rid of capitalism and greed goes away and we're all of a sudden perfect humans. That is why I think most people looked at this and went, this is part of that plan. I don't think that's accurate. A longer debt instrument is just a choice for you. It's not something that has to enslave you. Now let's talk about paying off your home. This is something that I hear even a lot of my friends talk about. I want to pay off my mortgage so that I don't have a monthly payment. Here's how I think the correct way to look at this is. If you have a 4% interest rate and you pay off your mortgage, you're saving yourself 4%. So that is what you just saved by paying off your mortgage. But you can't forget opportunity cost. Opportunity cost is there a better place to put my money to where I can earn more than that 4%? And when you're looking out in opportunity, or when you're looking out at opportunity right now, there's a lot more opportunity out there that can make you more than 4%. So if you put your money in the S&P 500 that has a historical return of about 10%, that's a 6% return that you are forfeiting by paying off your 4% mortgage. If you're looking at real estate deals, a lot of real estate deals are in the mid-teens to high 20% average annual returns. You're now forfeiting a lot of return by paying off your mortgage. So I don't think the holy grail should be paying off your mortgage. Now, my dad is the one that pressed me on this because my dad does not have a mortgage. When we sold St. Archer, my dad was an early investor and he made a lot of money. So much money that he was able to pay off his house. And the feedback he gives me is, Mikey, you are correct. This is not the best use of my money. But for me, I want peace of mind. I want to go to bed at night and I don't want to think about a mortgage. I don't even want that equation. And it's worth it for me to forfeit the higher potential return elsewhere so that I could sleep at night. Now, I can't argue against that. That is, at the end of the day, enjoy your life. Taking on so much stress with leverage that it's going to make you uncomfortable, I will always support you in that. Do not do that if you're somebody who's going to be stressed out and not going to sleep. If you're somebody who doesn't have that issue, that's when I think leverage should come into play. So the other thing, here's kind of the last one, is the affordability side. So everybody right now, if you're looking at the political world, with Zoran Mondani winning the mayoral race in New York, that has shifted all these political figures to now focus on affordability. Everyone has to say affordability. The reason why they say that is because it's a pain point. It's a pain point that everybody's feeling. But here's what I want you guys to focus in on. How do you actually solve affordability? You can't just say it and, well, that's actually scary to say. I'm going to correct myself. A lot of politicians will say affordability and say they're going to solve affordability, but they don't do anything to solve it. Here is the problem with this 50-year mortgage. It doesn't solve affordability. It actually will make affordability worse. So when I say the 50-year mortgage is a good move, if you're an investor, I am only talking about the investment mind. It is good for that. Affordability, why it's going to make it worse is it's going to increase the demand pool. There are going to be more people that are going to be able to buy. And with basic economics, if you increase the demand pool and you do not increase supply, that is inflationary. That is going to drive prices up. So right now, the 50-year mortgage is being marketed as a tool to fix affordability. It will not do that. It will have a reverse effect. So I do not think that is a viable option if the goal is to make housing more affordable. Another thing that just popped up is portable mortgages. There's a mortgage idea that sounds amazing until you realize why it does not exist in the free market. We do not do this in America. So what is a portable mortgage? A portable mortgage lets you transfer your existing loan and its terms into a new property when you move. So right now in America, what we do, when we sell a house, we pay off our mortgage. We take our gains, we go buy a new house, and then we put a new loan on it. That's how our mortgage, that's how our loans work in America. Outside of the country, this is an option. So what you do is instead of paying off your old loan and applying for a new one, you carry your old loan over. It has its current interest rate. But here's the challenge. Let's say you have a $500,000 mortgage on $1 million house, and then you sell it and you tell the original lender that you're going to roll that $500,000 loan into your new purchase, which is a $2 million house. How are you going to afford the $2 million house? Here's what happens. You usually have to take out another loan to do it. And so when you start thinking about it through the lens of the lender, that's something that the lender did not sign up for. The lender signed up for giving you 50% of the value with a $500,000 loan on $1 million value. They did not sign up to be in a secondary position on a more expensive house and you paying additional loans. So I don't think that's going to work. I don't like that idea. I know that's being touted as a possible option. I don't think that's ever going to make it to America. So I don't even actually want to spend much time on that one. I just want to say, don't do that. That's not going to come here. So let's just say for everyone that's marketing that idea, it's kind of a stupid idea. Let's go on what the politicians are doing. The politicians are going to talk about affordability. Why I say they're not going to do anything to solve it, because what solving affordability means is politicians moving out of the way. And politicians do not like moving out of the way. Politicians like being the solution, which means they like control. And so what do we have here to solve affordability? You have to add supply. What does it mean to add supply? Well, really, you're loosening zoning, you're speeding up the permitting process, you're eliminating rent control. We'll spend a second talking about that. You're cutting impact fees. What you're basically doing is making it easier for people to develop, which means you're getting government out of the way. And so I think a really good thing to keep in mind is every time more government is involved, prices are going up. Now, let's talk about the rent control one, because this is one that, if we're using Mandami as the example, he ran on rent freezes and increasing rent freezes. Why does rent freezes sound good? Well, if you're renting an apartment and your rent is going up, that's increasing your cost of living. So the idea that you don't have to have those rent increases sounds good, right? Here's the challenge. If you're freezing rents, you are making it impossible for investors to come in and develop. And so you're going to keep supply low. And if supply is low, what happens? Housing crisis, unaffordability, basically the scenario that we are in right now. And so if you look at all the cities that are really driving rent controls, they are the most expensive markets in the country. Let's look at an example like Texas, an example like Florida. We're spending a lot of time talking about these markets right now because from an investment standpoint, you're watching investors lose money. That's what's interesting. But what you're also watching is more affordability for the tenant. Why? Because investors want to make money. That's the first thing you have to know. Investors want to find opportunity. If there's opportunity for them to make money, they're going to put dollars into an asset class they're going to develop. So if you look at Texas, they put so many housing units on the market, they put too many. What happens when there's too many housing units available? You have to give rent concessions because you need to lease up your apartment. When you start giving rent concessions, which means a cheaper monthly rent for the tenant, prices are going down. When prices are going down, you're going to see a crash. That's what you're seeing right now in Texas. So investors are taking a bath. Tenants have more options, which means a lower monthly payment. So you can't avoid that one. I think us as the voter, here's what I think we need to do. And unfortunately, you don't see this at scale because it means a lot of work. When politicians are out there asking for our votes and they're saying things like, I'm going to solve affordability, we need to go, how are you going to do that? When they say rent freezes, our pushback should be, okay, if you're going to do rent freezes, how is anybody going to come up and develop? The answer is they're not going to. And so here's what we need to avoid. a small or short-term fix, which is going to result in a worse or more expensive long-term outcome. We don't want that. We ultimately want long-term to have a healthy housing market so that we're not spending all of our money just to live. So I think right now we're not seeing that with our political figures. Hopefully that changes. I don't know where I land on giving you guys a probability of that changing. I hope it changes, but we're not seeing it change. That's kind of the part that is really challenging. Last, on investing. I'm going to spend a little bit of time talking about investing. A lot of us have been told that the American dream is to buy a house, to own your house, to not have a mortgage, and that will become your tool to build wealth. And what you're seeing right now is the next generation is going, I can't afford a home, so am I screwed? Am I never going to have enough money to retire? Right now, I would say there's a strong case to be made that you should be renting. Like, don't try to buy your house, just rent. But if you're going to rent, I would really recommend you saving a certain percentage every single month to invest that money. Here's the good part for Gen Z. You guys have so many more options to make investments that our parents did not have when they were our age. You guys have real estate investments that you can make outside of REITs that are a crowdfunding option. That is so cool. Crypto. I'm not telling you to invest in all your shit coins or your hyped up coins. You guys have an asset class that is new, that is growing. I think that's going to be a huge opportunity to grow wealth in the future. Don't skip out on that. As far as Gen Z looking at investments, they are the most savvy generation with their finances that we have seen in a very long time. One thing I am going to mention is something that we just launched. We just launched a new offering where you do not need to be accredited. And we made the minimum investment $5,000 so that if you want to invest in commercial assets, we focus on apartment buildings and we focus on storage units. If you want to invest into real estate assets that have the opportunity to potentially grow your wealth, that's available to you. I will include the link in the description of this YouTube so that you can look at new opportunity. That's something that was not available 10 years ago. That is so cool that the masses now have the opportunity to invest in these commercial assets that have typically only been available for high net worth individuals. So with all that said, stay away from the noise, cut through it. I know there's a lot of people that are just giving you a blimp of the information and telling you you're doomed. You're not doomed. At the end of the day, you have a lot more control in your future than you realize. It's just when you have people telling you that the system's against you, it makes us feel better because it makes it feel like it's not our fault. I'm not saying that for everyone you're in the position because there aren't external factors. Of course there are. But if you look at yourself as having the ability to change your outcome, that's going to just end in a much better result for you. So don't give up on yourself. I believe in you. You are much more capable than you realize. Same with myself. I typically put a limit on what I can achieve. I know that limit is usually less than what's actually possible. So I hope this interview or this podcast was educational. I hope it was encouraging. Don't give up. The housing market will get better. If you can't get into a home, look for other investments. You can still grow your wealth. Thank you guys. We'll see you on the next episode.